All right. So, welcome to our first official WorkAway workshop. Yeah. So today our presentation is by Mark Kowalski. He's going to talk to us about tax considerations and COVID grants for 2021. And hopefully we can all mute ourselves during his presentation. And then at the end, we can all unmute ourselves, have a discussion, ask questions. And if you have any comments or any links or questions that you'd like to share, you can either put them in the chat box if you'd like, or you can save them for afterwards, whatever you're comfortable with. There's also a little reactions button. So feel free to use reactions. There's thumbs up and celebrations and raise hand for questions and all that. So yeah, let's all get started.
Awesome. All right. Thanks, Stephanie. And hello, everybody. I'm sure everyone's excited to learn lots about taxes. I know everyone's always keen on taxes, especially this time of year. So I'll jump right in. 2020 was a very unusual year with taxes in mind as well. Things kind of changed. Certain industries did really well, certain industries did not, and a lot of new programs got created during the year, which were very challenging to navigate. Programs were created by the government to assist people and assist businesses with what was going on. And these programs had elements of, protection against fraud, protection against abuse, and all that, which made them very challenging to navigate. So what I kind of want to do right now is just do a quick overview of what's different for 2020 for your personal taxes. So it's 2021 now, and March and April is the time to file your 2020 taxes. There's a couple things that are new this year that I want to go over. And then for businesses in particular, talk about grants and subsidies and things that are available for businesses to help support them during the lockdowns and during things that are still ongoing right now. I won't be touching on any of the personal side, the CERB and all that kind of stuff, just the stuff specific to businesses. And then finally, touch on a little bit of planning opportunities that exist as part of basically the circumstances that we're in with COVID. So let's get started. This is the nice and easy part. Luckily, not a lot has changed in terms of doing your 2020 tax return, your personal tax return. There's a couple of new credits. The main thing a lot of people will notice is if you did receive any kind of CERB or any of those benefits personally, keep an eye out for the government will send you a T4A with that income shown. But otherwise, the biggest change that we saw this year is the home office deduction. So this is for employees, so not people who are self-employed, not people who are employed by their own corporation. This is primarily for people who are employees of another company. Previously, employees have always been able to claim a home office if their employer required them to use it, but the considerations were very stringent on how much they required you to use it and what you were required to do with it. Now they've alleviated that because a lot of people had to switch to remote work because of the lockdown. So CRA came out with a very nice alternative way to file the home office deduction this year, which basically, if you did have to work from home, you don't need to get your employer to certify it with a letter or with a form or anything like that. You can just declare the number of days that you work from home, multiplied by $2 to a maximum of $400 for the year. And you can claim that as a deduction on your tax return. So not as a credit, which offsets the amount of taxes you have payable, but as a deduction, which reduces your income. Deductions are way better than credits. They reduce it at a higher rate. So definitely, if you were required by your employer to work from home, the home office deduction is worthwhile. The alternative, you can still file in the old manner, in which you have to show what percentage of your home you used as an office and claim against the actual expenses. The alternative still exists, and it's if you have any other employment expenses to claim, you still have to file under that method. You can't use the $400, $2 a day, $400 method if you use your car, for example, for work, or a cell phone that you pay for personally, or other expenses that you incur. So something to keep in mind if that's your circumstance, for sure. The Canada Training Tax Credit, this is a new one. This started last year, but it's only really available to start using this year, 2020. It's a $250 credit that carries over year, and it's meant towards tuition fees, exam fees, things that you pay to develop your education and your career. And it's a refundable credit. So what that means is it goes towards your tax return, and if it ends up creating a refund on the amount of taxes that you owe, you'll actually get that money back. Whereas a lot of credits, the way that they work is they just reduce taxes, and if it goes to 0 or below, then it stops. So this is a very interesting one, especially because it's going to be cumulative. It's going to grow year over year. So it's definitely one to keep in mind if you are planning any kind of education in the next year or a couple of years, to keep in mind that there's going to be a deduction available. And then finally, digital news subscription credit. If you subscribe to any kind of like Globe and Mail online or anything like that, you should get a tax receipt from them. You can claim that this year. It's up to $500, and you get a 15% credit on that. So that's it for the personal tax side. Because I'm going to switch into something a little bit different now, maybe I'll ask if there's any questions on this stuff before we get into the business credits and business subsidy stuff. If anyone just wants to give a reaction with their hand, the reaction button thing, if you have any questions. Tim's got one.
Just going to ask, the home office deduction is the T777S and the corresponding T2200S, I guess, right?
Yeah, so the T2200 is if you have to use the complicated, the more detailed method of filing. So you have to get your employer to certify that you were required to use your home as you would have had to in previous years. If you're using the home office deduction, the $400, $2 a day, you don't have to get that form from your employer. You can just file with the, I think it's T777S is the one to file the $400 claim, but you don't need to get anything from your employer. Awesome. All right, anyone else? No, we'll move on. So COVID grants. So these have been around for basically since near the start of the pandemic, since June, but they are still active right now. So if your businesses are eligible for these, definitely something to keep in mind, especially the Canada Emergency Business Account. This was probably the most significant one for a lot of businesses. This is a $60,000 loan that you're able to receive from the government towards your business, out of which 20,000 of it is forgivable, and 40,000 of it needs to be repaid, and it needs to be repaid by December 2022. So it gave you up to 2+ years of zero interest financing, with 1/3 of it being completely forgivable. One thing to keep in mind with this is when you do repay this loan, when you do repay this loan and you claim that $20,000 grant or $10,000 if you applied for it initially, that needs to go through to your income as well for your business. So that's something to keep in mind as we start going through this, is that you need to declare the income on this grant in your tax return. The CEWS, the CEWS, the wage subsidy, that is still ongoing right now. Currently, it's projected to end in June. We're in the 13th period of it right now. This is basically a subsidy that's calculated comparing your revenues before the pandemic to your current revenues. And the drop in those revenues gives you an entitlement to a subsidy of your payroll costs ongoing. So we're in several months. We're in almost a year of this program right now, but it is a very significant program, and a lot of my clients are still using it to this day because the lockdowns, especially the most recent one, January, February, had a really significant effect again on a lot of businesses. So this program is definitely something to keep in mind if your business is qualifying for this and if you have employees. And then the final one is the CERS, the rent subsidy. This is a bit of a newer one. We're in the 5th period of this right now. This one goes towards the cost of a commercial lease. So if you have one, it's the previous iteration of this required you to kind of work with your landlord to figure out how much you were able to claim, and your landlord had to pitch in for a percentage and you had to pitch in for a percentage. It was very challenging because landlord's got a commercial lease in hand. They don't actually need to forgive any portion of your rent. They've got a contract with you that doesn't really take into account whatever's happening. They're entitled to that rent. So a lot of people had a lot of trouble accessing those funds initially. This one is directly between the tenant and CRA, and it just happens behind the scenes. The landlord doesn't need to get involved at all, so it's a lot easier to claim. You just have to declare what your revenue drop was and whether you were required to lock down. And they send you a calculation. You can do a calculation online, and they send you a check basically for a portion of your rent. So definitely want to keep in mind if you've got a commercial lease. So these are basically the grants that are run by the federal government, by CRA primarily. There's a couple other ones. There's a Regional Relief Fund. This is a bit of a less well-known one, but this one is also run by the federal government through a different organization. It's the Organizations of Economic Development for each region. So we would fall under the Southern Ontario Economic Development Organization. there's two branches to this. One for $40,000 and under, which is operated as a conditional grant. So it's a loan, but it can be forgiven partially or in full, depending on how your application gets processed. And then from 40,000 to up to 400,000, there's a loan available as well, where if you need financing to get through at a larger amount, you can apply for this as well under that branch. But you expect, I believe, either the full amount or the majority of the amount to be repayable. This one's different than the ones on the previous page in that you actually submit an application for this one and you have it approved the way you would traditionally have a grant be approved. Whereas the other ones, it just compares if you met the eligibility criteria very cleanly. This one is more, you get a grant person who actually reviews your application, approves it. You add some more detail about how your business is struggling during this and what you're going to do with the funds. So it's a little bit harder to access, but it can be a huge lifeline for a lot of businesses. And the final one is the Ontario Small Business Support Grant. This one is targeted to specific industries that are affected by the lockdown. In particular, this is meant for the lockdown that happened from December, when right before Christmas, when the Ontario government shut down, and lasted basically until mid-February or so, because then it got extended and extended. This one is between $10,000 and $20,000, and it's entirely a grant, but it limits what sort of industries you're able to, what sort of industries are able to apply to it. So it's meant more for retail type settings and personal services and that sort of thing, things that are very heavily affected. But I would recommend, if you think you might qualify for that, to have a look at their website and see. They're open until mid-March or end of March for receiving this grant. And I think it's one of those where they have a pool of money, and as people apply for that money, it slowly goes away until it's all gone. And finally, the fun part, tax planning after COVID. So a lot of people experienced a lot of change in their situation. You know, if you had a financial plan going into COVID, or if you had a rough financial plan in your mind going into COVID, and you know, things changed for a lot of people. A lot of people had worse years. Some people had better years. It really is entirely uneven. You know, it's just been a massive shift in the dynamic. So there's a lot of things to consider now when you're filing your personal taxes in terms of how to basically plan around what happened in the last year and what's going to happen going forward. A big one that I'm seeing with a lot of my clients right now is RSP contributions. If you have, for example, you know, predetermined RSP contributions that you're making all year, or maybe you stopped them after you had a break in employment or something like that. If your income is substantially lower this year than it was in previous years, it might be worthwhile not claiming your RSP deductions for the current year and letting them flow over to future years to get the maximum benefit out of it. You always have to report your RSP contributions on your tax return, but you don't have to claim the deduction for them. You can carry it forward to future years. So very worthwhile consideration to see if it's worth using your RSPs if your income was significantly affected this year. Income splitting through prescribed loans is always a tax strategy. COVID didn't really affect it very much, other than the fact that interest rates right now are very low. So how this works is, if you have you know, two spouses, one spouse works, makes a lot of money, the other spouse either doesn't work or works less and makes less money, you have the ability to loan money between the spouses to invest. So one of the spouses, you know, the money that you invest, even if it's in a joint account, it gets attributed to the person who earned it primarily. So one of the spouses can give the other spouse a loan of a certain amount of money to invest, assuming your TFSAs have been maxed out and your RSPs have been maxed out and that sort of thing. Then the tax that comes in from that investment, you know, capital gains, the interest and the dividends, goes to the lower income spouse, and the lower income spouse then has to just pay interest at that prescribed rate to the higher income spouse. So then it gives you the ability to sort of shift some of the investment income that you have to in your family and make it a little bit more worthwhile. Opportunity for a new freeze. This would be a very significant topic. We could probably spend an entire workshop on it on its own, but basically, if you're an owner of a corporation, a freeze is a tool that you can use to identify the value of the corporation at this time and transact based on that value. So you can either recognize, you know, the value in the corporation and recognize a gain on that, or you can freeze the value in that corporation and issue new shares to new shareholders or family members and that sort of thing. for a lot of businesses, COVID has caused the valuations of their businesses to change dramatically. And in particular, if you're in a retail involved business or anything that's basically general public facing, in general, the valuations for a lot of those businesses have dropped dramatically. That sort of gives an opportunity to examine what sort of structures you have, especially if you're looking at, for example, older generation wants to pass the business down to the younger generation. They might be able to take advantage of this really low value and pass that business on at the lower value to the younger generation, who can then recover that business's value in their own hands. So then they don't have to pay tax on it until they are ready to pass on that business, which is going to be years and years from now. So definitely something to consider if that's a situation you're in. And then the final item, this is not really necessarily COVID related. This is more federal budget related, but there's a rumor that as part of the recovery from the massive amounts of spending that went on to keep the economy moving during COVID, that one of the targets may be the capital gains rate, the capital gains tax rate in the future. So right now, capital gains are taxed at 50% of, they're taxable at 50% of the amount you actually earned. So if you buy shares for $2,000, sell them for buy shares at $1,000, sell them for $2,000, you made $1,000, but only $500 flows through to your tax return. There's talk that that may be increased over the next couple of years. And what that means for people is examining what sort of kind of holdings that they have that may be susceptible to a rate change in going forward as part of their planning, and in particular estate planning is going to be a significant one. If they made a change like this, chances are that they would make it proactively. So you would have, gains that you already are sitting on right now would still be at 50%. It would only be from new gains. But if you own shares of a small corporation, or if you own a cottage and a personal residence where the cottage or one or the other has to be taxable, there may be an opportunity to use some sort of estate planning to deal with the capital gains now while we know the rate, in anticipation of it potentially increasing. So a lot of things to consider. I'm sure I blitzed through that a little quickly, but any questions, or if I want to open it up to just a general discussion right now? Yeah, Vince, go ahead.
Mark, it's the first time I had heard about the income splitting through prescribed loans.
Okay.
That's pretty neat. Now, if a spouse does lend money to another spouse, does there have to be some sort of repayment of that money eventually, or is it just kind of one of those, kind of a forgivable loan?
Yeah, so it's interesting because there's no rules against gifts between spouses. So what you're really doing with the prescribed loan is you're really trying to identify that this is not a gift, that this is in fact a loan. So there doesn't need to be any principal repayments of the loan, but what there does need to be is actual physical interest payments. So by the 30th of January of the next year, that spouse needs to have actually physically handed money from one person to the other. So you need to be able to prove to CRA that actually did happen. But that's the only requirement, really.
Yeah, very interesting. No, thanks, Mark.
No problem.
I have a question as well in regards to the prescribed loan.
Yeah, for sure.
Does this only apply to spouse? Like, can you do it yourself as the sole shareholder, or would it have to? Yeah.
It doesn't apply between a corporation and a person. There's separate rules for that. So a corporation can lend money to an individual, but if that goes on for more than a certain amount of time, that has to flow through to that person's income. Otherwise, it's because it's deemed to be a shareholder benefit.
Right. Okay.
So between people, basically.
Right.
The prescribed loans work.
Okay. Thanks.
No problem. Anything else?
I was just going to comment, maybe for Vince's benefit, that I used to work in the high-tech industry back in the heydays of the 90s, and my spouse didn't work. So a large part of our compensation was stock option based, right? And the gap in income was substantial, as you can appreciate, right, between myself and her. So they do work very well. We did them for a number of years, right? Because it resets the adjusted, and Mark should speak to this, but it resets the adjusted cost base then of any of, like we did, in addition to loans, we also did some share transfers, right, from the company I work for to reset the adjusted cost base, so future growth. So maybe there's something there for WorkAway, right? I don't know.
Yeah, absolutely. It's definitely worth having a consideration, especially if that's the longer term plan, is that one spouse is working, the other spouse is not, or is working less. Definitely always something worth considering, because it can have, it can have a very small benefit at the beginning, but an enormous benefit towards the end.
So Mark, talk a little bit about the Regional Relief Fund again. I didn't metabolize mentally all of it. The Ontario Small Business Support Grant, I kind of got.
Right.
SIRS and SUS, I kind of got, but the Regional Relief Fund.
Yeah, so that one it's separate. It's run by a economic development organization, which is a federal government organization, but it specifically targets one part of the country. Ours is, like I said, Southern Ontario. So there's two branches to it. When you apply for it, you'll be asked whether you want to apply for the part that's from $0 to $40,000 or the part that's from $40,000 to $400,000. The $40,000 and under part is more of a conditional grant. So you apply based on what you need, what sort of things you're going to be spending on, and they review that grant, and then they either approve you or deny you, but they basically give you that money. The higher side, through $40,000 to $400,000, it's a loan, but you still apply for it in that same manner where you explain what you're going to use this money for. But it is still a loan that is repayable. I think there's a portion of it that ends up being a grant, but I think it depends on how they view your application, what you get approved for, and that kind of thing. But it is a lot more onerous than the previous ones, especially like compared to the emergency business account, which is an application. I think the last one I did took less than a minute to do. You just pull up your T4, you show how much income you had, you show how much payroll you had, you apply for it, and you're done. This one is a lot more in depth. It's a full application that needs to be done, and you can get rejected for it if you don't meet certain criteria or something like that. Yeah.
Yeah. Thank you, sir.
No problem.
So in your experience, Canada Emergency Business Account sounds like it's popular, and
yeah,
you have a lot of clients that have qualified for that.
That one would probably be the most popular one, because it's, especially right now, like I find in general getting financing from banks is very challenging right now because of, related to COVID. But in general, I just find the banks are not lending as freely as they would have been a year ago, and people are more in need of financing now than they ever have been. And this is sort of one that's just no credit application, no holds, no nothing. It's just boom, here's $40,000 of it. You only owe, or 60 now, you only owe us 40,000 back at the end of the day. So it's, in part free money, in part a lot of financing at no interest for 2 years. So quite worthwhile. Okay. Yeah.
And the qualifying criteria for that, if I look, I'll find them on canada.ca/something.
For sure. Yeah. The biggest kind of hurdle to it is you had to either have payroll in 2019 of a certain amount, or you had to have eligible non-deferrable expenses, as they're called, of $40,000 at the time when COVID started for the year. So that's generally the biggest hurdle. If you didn't employ people before COVID, then the application is a little bit more challenging. You have to show that you had the eligible non-deferrable expenses. But yeah, that's the gist of it. Awesome. All right. I think that's all. So thanks, everybody.
There you go. If we want, everybody can unmute themselves in case there's anything that you guys wanted to discuss, or I just want to say a big thank you to Mark for preparing the presentation for all of us.
My pleasure. Can talk
Mark.
about how beautiful the weather is and how excited I am for the spring.
12 degrees today. We play drums outside, Vince. Crack out the bass guitar and off we go.
There, it's right. Yeah. Well, thanks, Mark. That was a really good presentation. Thank you.
Pleasure.
Yes. Thank you, sir.
All
Very
right,
good
thanks
as well.
a lot.
And you still have your office at WorkAway, correct?
Absolutely. Oh, yeah.
Okay.
Yeah.
Good. Excellent.
Yeah, and we're expanding as well, Tim. So.
Yeah, I've read that. I'm the bookkeeper, as you perhaps know, right, for one of the businesses that I still rent some space, right, from WorkAway.
Good.
So, Mark, disclosure be known, Dustin we've had discussions about changing accountants, right? So part of my reason for dialing in today is to qualify you and say it the way it is.
All right.
So it's gone well for what it's worth.
Awesome. I'm glad to hear that.
So we may chat again.
Awesome.
FYI.
That's great.
Thanks again, Mark. Thanks, everyone.
Yeah, and thanks
Thank
everybody
you.
for joining. If you have any questions about workshops, feel free to email me. And hopefully we'll have some more planned. We already have one in the works for April. So hopefully we'll keep them rolling and get
Great.
some more variety. So thank you all for being our guinea pigs on our first workshop.
No problem. It's been great.
Thank
See you on
Thank
the
you
next
very
one.
much, Mark.
All right. Thanks, guys.
Bye.
Bye-bye.